Hi, I'm Eddie Sunderji, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. As a side note, Jeff's newsletter can be found on Substack at hugeinsights.substack.com. He published his weekly piece in the playbook on Sunday night. It's been a pretty subdued week so far, Jeff, but welcome, and we're always happy to have you. And let's talk some stocks.
Yeah, I see it as kind of the calm before the storm, Mehdi. And honestly, last week, there's a lot of action going on. I think between the Fed meeting and the fact that the FOMC did decide to raise 25 basis points, kind of in line with expectations. I don't think there was a lot of, um, you know, uh, you know, people deviating from what the futures curve was projecting. I mean, there was a lot of talk about how they shouldn't raise, but there's no question that the Fed has a battle to fight against inflation at this point, and I think it's a two-front war now. I think we've got a potential recession looming in the weeks and months ahead, and I think inflation isn't going to dissipate anytime soon because a lot of the inflation showing up on the services side, and so Powell had to have somewhat of a hawkish tone that was, to some extent offset by Yellen coming in at one point saying, "Hey, don't worry, we're going to save the system." Then the next day coming out saying, "No, we're not going to save the system." Then the next day coming out saying, "No, just kidding, we're going to save the system." Don't worry, folks. At the end of the day, I mean, we have stagflation brewing around the edges here, and I think that's a very, very difficult two-front war to fight for the Fed. They don't have the tools to fight both battles at the same time. And so, I think it's going to be a give and take back and forth. We've thrown the word deflation out there, and it wouldn't surprise me to start to hear that creep up into the remarks of Fed officials in the months ahead. But at the same time, I don't think we're going to see inflation disappear. So I think you're going to see this kind of weakness in growth and weakness in employment, more layoffs being announced weekly from big companies in the tens of thousands, as we've seen. And, that leaves us with, a market that is kind of on the razor's edge at this point. And I don't think we're far from a point where the market is going to recognize and resync up with the economic realities that are brewing around us. So, we continue to recommend our readers, subscribers, investors maintain minimum net equity exposure to the extent to which it is possible within their mandate, and maximize cash reserves within, to the extent that within their mandates for institutions. For individual investors, high net worth investors, family offices, we've been recommending 80 to 90% in short-term T-bills and trading around the edges opportunistically. Why would you put on, asset risk in this environment where it's a two-way front? You can't win either way, but you can lock in short-term at right now 4.7% risk-free for the next 6 months. I think that's a great place to kind of wait out the storm and wait for opportunities to present themselves. And as they do, leg in. But the market has not bottomed, in our opinion. There's a long way to go to the downside, and we'll talk about our targets in a minute.
Cash and short-term T-bills, that's the message. And you've been consistent on this. So this isn't a new story. At least, this picture has been painted definitely over the last several months, and it seems to be a sensible play here. Jeff, before we dive into some of the technicals and the chart action around your weekly update, you had some global macro commentary, specifically around Syria. Can you run us through your thoughts here?
Yeah, with respect to the weekend attacks by Iran on U.S. bases in Syria, I find it a little too convenient that our long-standing adversary in the Middle East, Iran, chose to suddenly attack U.S. bases just 1 month after President Abraham Raisi of Iran met with President Xi Jinping of China. That was an historic meeting. And the idea was that, oh, China's trying to shore up their relations with Iran, and they need to identify a consistent source of energy, right? And here we are a month after that meeting, while Xi Jinping is meeting with Vladimir Putin, we suddenly get an attack on US bases in Syria that was unprovoked and quite out of the blue. And, this to me suggests that China is setting themselves up or positioning themselves in something of a phantom menace capacity, if you will. It's we can't directly link China to the attacks, but it's very convenient that their agreements with Iran took place just a month earlier. And, it's convenient that it occurred while they were meeting with our other adversary in East Europe, Vladimir Putin. And so, I think there's a new axis of evil developing. And, we've been talking about it around the fringes a little bit in our work. I don't think China's our friend. I think China's our adversary. And I think US businesses are unfortunately too ingrained in China at this point to state it plainly, as evidenced by Tim Cook's recent visit to China. But I think US businesses are realizing at this point that they need to distance themselves. And that will take years to happen, but it's a sad state of affairs right now.
Definitely a hot topic. Another hot topic over the last several weeks, there's been a huge disruption in the banking system. We've had some fails, we've had some near fails. This week, you've got this quite shocking chart, but you allude to the fact that you don't think that this is over quite yet.
I do not. And just so you know, I borrowed that chart from Francois Trehan, who published it over the weekend. He borrowed it from a paper that was written. In fact, I can't even remember the author, but it really was a study done about the banking crisis in the 1980s. And for those who don't recall, the quote unquote S&L crisis in the late 80s, some 1,600 banks and S&Ls received aid from the FDIC. Now, people are losing their minds because we had a bank failure, right? Back in the 80s, banks were failing weekly, dozens. In fact, over 300, no, I'm sorry, slightly below 300 banks were ultimately shut down and their assets seized and auctioned off by what became the Resolution Trust Corporation, the RTC. And, that went on throughout the 90s. So, it was just about 25 years ago that the RTC was finally completely liquidated. So far we've seen two US banks fail, seized by the FDIC, assets sold, auctioned off, if you will. The Citizens deal with Silicon was heralded as being, a unbelievable opportunity for Citizens. We'll see. I think a lot of the loans in that book are going to be distressed loans, and they've got plenty of backing from the FDIC on this and authorities. So I'm sure they know what they're doing. But I think we're going to see more than two banks fail in the U.S. In fact, the cockroach theory itself suggests that there will be more. This is probably the beginning of a series of bank failures that may end up being something in the 10 to 50 range before it's all done. I don't think it's going to be hundreds of banks that are shut down. I mean, I think the systems are improved since the 80s, but this could progress and it could take years to completely unwind the problem. So with history as our guide, buyer beware.
Well, that's quite the scary picture you paint there. And also, one of the topics that's been coming up over the last few weeks as well is commercial real estate. It feels like this could be the next shoe to drop as well. And looking at this chart as well, how small US banks are holding 70% of these commercial real estate loans as well. This is not the prettiest of pictures.
It's not. In fact, that's kind of our point. And we do think commercial real estate is the next shoe to drop. with 70% of these CRE loans on the books of, not just regional, but community banks. Many of these loans are on the books of small community banks that have a very concentrated loan book, usually, 5 to 10 big players in a particular, geographic vicinity, right? And once those guys get into trouble, these are handshake type relationships where, they're going to help each other out. But at one point, someone's going to yell uncle. And, in my opinion, what's happening right now, if we take a look at, and this is just some research I've done over the weekend, about 60% of those 70% of loans that are on the books of small regional and community banks are actually office properties. Okay. And the big problem with offices, you probably well know, and you can see it plainly in New York, is vacancy rates are, abjectly off the charts, right? I think nationally we're at 17.5% vacancy, but I've heard tales, if you will, and read some statistics that there are some major metropolitan areas around the United States of America where office vacancy rates are near 70%. And so it is not just a small problem. It's a huge problem. And in fact, it's showing up in loan books already. We're seeing loans that are delinquent, and this data comes from ISIB, which is an office property, research company. And they indicate that in February, delinquencies jumped 55 basis points to 2.38%. That's a big percentage looking at, a delinquent loan book in office, okay? But that's not all, folks. About 4.43% of all loans on the books at these small banks are in a workout stage at some point. So, they're near default, basically. They're being worked out. And so I think that these, really shaky undercurrents are affecting the fundamentals of the industry, right? Net operating incomes are under a lot of pressure. And I think a wave of commercial real estate defaults in 2023 is not off the table.
So, Jeff, it's really interesting you say that. And just to add to the point of occupancy rates, I saw a stat yesterday that a lot of areas like San Francisco, Austin, New York are running in like the 40–45% occupancy levels of pre-pandemic levels. And again, another additional point in regards to the debt structure in those investments. We've seen defaults from the likes of Blackstone already. I'm trying to think who else is it. Brookfield, First Investment. There's been a few corporates that have, and we're in March. So there's, this 2023 does still have some room to run in this.
Blackstone lowered the gates. They're not letting you out, and so I think if you've got an opportunity for liquidity in this space, you got to hit the bid because that window is closing rapidly if it's open at all.
Well, let's switch to the yield curve. So an inverted yield curve has preceded every recession over the past 50 years. Judging by this data, you're still firmly in camp recession.
No doubt. If it's not what's happening in the real estate market right now that is the catalyst for this ultimately, or the banking industry, it will be, I think just a recognition of the economic reality around us as earnings revisions continue to pummel stocks. This is no joke at the end of the day. I mean, the inversion, I believe, in every case, looking back in the past 5 decades, has only been the shot across the bow. Okay, I think it's the re-steepening of the yield curve that really needs to be something that's attended to, right? That is the indication that torpedoes are in the water. And at this point, avoiding those torpedoes, especially with the degree of skepticism that seems to pervade, economists, certainly Wall Street economists, as to whether or not the U.S. is going to be in a recession, it's shocking to me. if the writing is on the wall. I mean, these guys, I don't know what they're smoking. I mean, there's going to be a recession. The only questions that remain unanswered at this point is how soon is it going to hit, and how deep, broad, and how long is it going to last? I mean, what is the magnitude of the recession is really kind of the open question here. I think we're weeks to months away from clear evidence, irrefutable evidence, if you will. The only question that remains beyond that is this going to be, a multi-year situation, like, say the 80s, 1980, 81, where we kind of have this, recession, then another recession? Or is it going to be, something that we can traverse? And I think it's going to be, the former rather than the latter. One of the things that is starting to be recognized, I think, is weakness in the stock market, and it's not showing up in the indexes as much as it's showing up in the breadth. If you take a look at the number of stocks that are now trading above their 50-day moving average, we're sub 30% right now. Less than a third of the stocks in the S&P 500 are trading above their 50-day moving average. Yet the index has been basically flat, in a range, right, since May of last year. I think that we're very, very close to a point where, the index itself syncs back up with the reality of the economy. And, this trading range, and we've kind of illustrated it here as kind of a triangle, if you will. Well, in technical analysis, one of the core concepts is that, lateral consolidations of the triangle variety tend to resolve in the direction of the previous trend. Clearly, the previous trend was down since January of 2022 into May of 2022. And this lateral consolidation that's been in force since, kind of, buffeting itself up and down a couple hundred S&P points vis-a-vis 4,000, that close to a point where the trapdoor springs open.
Yeah, thank you for running us through that. Let's have a look at some technicals here. Let's have a look at the 3-year. This is a 3-year weekly view. Run us through here, because obviously we know your bigger picture scenario. Let's have a kind of grind down here a little bit.
Yeah, if we look at this bear market through the lens of the Elliott wave principle, we conclude that a 5-wave decline is the beginning of a larger degree bear market. And so we saw 5 waves down into the June 17th low. That initial decline, in our view, is primary wave 1. We saw a 3-wave rally, a counter trend advance, if you will, into the August 16th high. And that recovery rally, in our opinion, ended primary wave 2 of this larger degree motive wave. Now, since that time, we've put in kind of further subdivisions. We're counting them as intermediate wave 1 down into the October 13th low, and intermediate wave 2 up into the February 2nd high of primary wave 3 down. And so since February 2nd, we've moved down in 5 waves, and we count that as minor wave 1 of intermediate wave 3 of primary wave 3 down. We've experienced a small degree, minor degree, corrective or counter trend advance, which will ultimately prove to be what will be minor wave 2. If we've topped already, and I think we have on March 22nd, then I think the next wave down here is minor wave 3 down, and that should carry us down through the October 13th lows. It's really a third degree decline at 3 degrees, or third wave decline at 3 degrees of trend: minor degree, intermediate degree, and primary degree. And this should be a powerful decline. Once we see the trapdoor snap open, there will be nothing stopping this. It will be an epic plunge. And so we see that ultimately carrying primary wave 3 down into around the 2750 to 2400 range. We get that range from a variety of Fibonacci measurements, taken from different points. And, I think it's a pretty logical range and high probability range for primary wave three to terminate. Now, once primary wave three terminates, we'll get another lateral consolidation, before a fifth wave plunge ends cycle wave A down, which, could carry the S&P 500 as low as, say, 2250 in our opinion.
Wow, still that 2250 level. Jeff, can we have a look at the market internals? Because they also don't necessarily give us the warm fuzzies.
Market internals have been weak, right? They improved somewhat last week. I think about 51% of the issues in the S&P 500 advanced, 49% declined. So, pretty neutral, but, the 5-week moving average of net advancing issues is still negative 19%. And so, at the end of the day, breadth has been exceptionally poor. Momentum bounced from a near oversold condition, but it remains below the median line on the 5-week RSI oscillator, which is our preferred short-term momentum measure. But, at the same time, when we see momentum trading below the median line, that's basically a bearish indication. There's not enough strength in the market to push into, say, a positive regime. So with that, we focused on volume then, right? And so volume last week, 63% of the issues were positive, but that's pretty weak for an up week, right? We'd like to see something closer to 80 to 90% to give us confidence that there's some sustainability or durability to a rally. We don't see that here. This is a weak rally. It's not attended by strong volume and strong up volume. And if we look at net advancing volume for the last 5 weeks, it's 2 to 1. That's kind of below average. You don't get big bull market rallies on 2 to 1 net advancing volume. It's got to be 3, 4, 5, closer to 5 or above. Usually 8, 9. When you're getting kind of a breakout, right? And then it kind of sustains in that 5+ area. Two times advancing volume. I mean, to me, that's weak.
And looking at investor sentiment, we're kind of sitting in that neutral zone there as well.
Yeah, it's interesting. The survey data remains overtly subdued, put it that way. If you look at the AAII survey of individual investors, the net bulls minus bears, right? The bull bear spread, which is the right way to look at it. It's negative, right? But it's not a new extreme, like many are advocating, suggesting, alluding to. I've heard numerous strategists out there saying, "Oh, sentiment's so bearish, it's record bearish." It's like, it's not. We were substantially lower in terms of the bull bear spread back in October of last year when it got down to negative 42. We're at negative 29%. So, it's bearish. It's not an extreme. If we look at the name exposure index, this is professional investors surveyed by the National Association of Active Investment Managers. We're at 53% net equity exposure. That's neutral. 100% is bullish. 50% is neutral. Below 50%, then we start to kind of get into that sub-neutral level. I think the one thing that we should remember is that even if sentiment's bearish, the consensus is right 70% of the time. It's only at extremes where sentiment really makes a big difference, and so we're far from an extreme at this point.
Let's have a look at some of the sectors from last week. There was obviously a couple of big moves, but real estate seems to have also started its downturn here.
Yeah, no doubt. The REITs were down 1.3% last week. They were the worst performer. They were followed by utilities. Utilities were down 1.2%. Seems that there's no bid for yield in the market right now. I think the real issue is with REITs in particular is that you know, the rats have already left the ship, right? At this point, and so I think anybody who's still in REITs, they've forgot to look at the loan books on these things and look at the debt coverage ratios. And I think where we're really seeing some weakness in REITs is net operating income growth. It's not growing. In fact, it's negative. And so, especially in office, retail, and the strong area is multifamily, right? Because no one can afford to buy a home. But we're building so damn many apartment buildings around the country. At some point, supply is going to overwhelm demand, and at some point, prices are going to careen lower in the housing market, and we're going to get some restabilization and equilibrium between those two. And so, I honestly don't find any areas of real estate to be attractive at this point. With respect to what sectors I'd be allocating to, I had been holding out some hope for industrials and materials, but with what's happening right now in the banking system and the resulting credit crunch that I think is impending at this point, and likely being experienced at this point, I think that we should start to expect some order fall off in a lot of industrial companies and materials companies as well. And so, from that perspective, I think that a shift to more defensive areas probably makes the most sense at this point. I would use weakness in utilities, staples, and healthcare as an opportunity to shore up and strongly overweight those positions going into the balance of the year. Basically, I would be looking to underweight tech, underweight financials, obviously, real estate, obviously. I would probably be market weight when it comes to, say, energy, materials, and industrials at this point. And I'd throw communications in with technology, and of course discretionary, which is dominated by Amazon and Tesla. And Tesla's not a stock that we're favorable toward at this point.
Great, thank you for that sector breakdown and the allocation side. How about some stock picks? We're on our my favorite part of the show, the top actual trade ideas. What do we have here?
Yeah, well, within technology, if there was an area that I would want to give any attention to, it would be semiconductors at this point, and especially semi-cap equipment, because there's no question that the U.S. is trying to rearm itself in terms of its production capacity when it comes to semiconductors. And companies like Lattice Semiconductor are in the sweet spot there. The stock broke out and made a new all-time record high last week. The stock's trading around 90 and change right now. Broke out above 84, which gives us the ability to count a measured move up to 124 vis-a-vis a one-year cup-style base formation. And, we think it's likely the stock will get there. As long as it holds above 83, we'd stick with it. But we'd set our stop loss at 83, just below that breakout level. That sets up a nice 4-to-1 positive risk skew for the stock.
And Jeff, anything on the short side?
On the short side, we're gonna focus on commercial real estate again. The largest commercial real estate broker in the U.S. is Marcus and Millichap, symbol MMI. The stock went out around 30 and a half or so last night. This stock has basically completed a 2-year classic pattern top formation of the head and shoulders variety. It's breached trend, it's breached its neckline, and the stock having broke below $33 gives us a good count to about $8 on the downside. We would set a stop loss at 36 to protect capital. But if the stock hits our target, that's a better than 3-to-1 positive risk skew on the short side. If you're a long only investor, this is a definite avoid.
Jeff, thank you for that 3-to-1 on the risk skew. What a way to finish. As always, really appreciate you sharing your thoughts from Alpha Insights with us here at Your Finance TV.
Of course, always a pleasure.
And I want to thank our viewers, and I'd urge you to check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, good luck investing.